So you want to own a gym. You picture rows of shiny machines, a steady stream of members swiping in every morning, and a fat monthly check rolling in from thousands of people paying you to not show up. Buy some equipment, put a sign on the door, sign people up for autopay, and let the money print itself. That's the mental picture almost everyone starts with. That picture is a lie. More than 80% of gym members never use their membership more than twice a month, and yet the average gym still runs on razor-thin margins of just 8 to 12%. If the whole business model depends on people paying and not showing up, why do so many gyms still go bankrupt? So here's the real question nobody asks. If gyms are basically getting paid for nothing, why is this one of the hardest small businesses in America to actually keep alive? Let's zoom out first. A single Planet Fitness franchise costs somewhere between $1 million and $1.5 million just to open the doors. On the other end, Equinox charges members up to $500 a month for what is essentially the same square footage with nicer towels. In between those two extremes sits an industry where thousands of independent gym owners shut down every single year, while a handful of chains have built some of the most profitable real estate plays in retail. Somewhere between the $10 a month Planet Fitness card and the $44,000 a year Equinox membership is the actual business model, and almost nobody outside the industry understands how the math really works. So where does the money actually go? Let's break down the cost side first, because this is where the naive picture falls apart fastest. Rent is usually the single biggest line item, often 10 to 15% of total revenue, and gym owners frequently sign 10-year leases before they've proven the location works. Equipment is next. A single commercial treadmill runs $4,000 to $12,000, and a fully equipped mid-sized gym needs somewhere between $250,000 and $500,000 in machines alone before a single member walks in. Then there's staffing. Personal trainers, front desk staff, cleaning crews. Payroll typically eats another 20 to 30% of revenue. Insurance is the quiet killer here. Liability coverage for a commercial gym can run $3,000 to $10,000 a year, and that's before a single lawsuit. And here's the part almost nobody thinks about: equipment depreciation and maintenance. Treadmill belts wear out, cable machines snap, HVAC systems in a room full of sweating bodies fail constantly. Owners routinely under-budget maintenance by 50% in their first year, and it's usually what kills them by year 3. Add up rent, equipment, payroll, insurance, and maintenance, and you're often looking at 85 to 90 cents of every dollar gone before the owner sees a cent of profit.
So, if the costs are brutal, how does anyone make money? This is where the revenue side gets interesting, because a gym isn't really one business, it's 3 or 4 stocked on top of each other. The first source is the membership fee itself, the one everyone assumes is the whole business. This is stable, recurring, and boring, which is exactly why it's valuable. Planet Fitness built an empire on $10 a month memberships, and CEO Chris Rondo has openly said the entire model depends on people signing up with good intentions and then never showing up, because a gym with 10,000 members who all showed up every day would physically collapse under its own foot traffic. The second source is personal training, and this behaves completely differently. It's volatile, high margin, and dependent on individual trainers rather than the brand. A single trainer can generate $80,000 to $150,000 a year for a gym, but that revenue walks out the door the moment the trainer quits. The third source is retail and supplements, a smaller stream but almost pure margin. Protein powder that costs $15 to make can sell for $50. And the fourth, often the most overlooked, is ancillary services: tanning, childcare, group classes, juice bars. Lifetime Fitness built an entire luxury brand around stocking these ancillary streams on top of the base membership, turning a $150 a month gym membership into a $400 a month lifestyle subscription. Now, here's the counterintuitive twist almost nobody outside the industry knows. Gyms are not actually optimizing for people to work out. They're optimizing for a specific ratio: enough people to pay and not too many people to actually use the space. Planet Fitness openly targets 10 times overselling on membership capacity, meaning for every treadmill, they expect 10 people paying for the right to maybe use it. This is why the entire industry quietly prays for what insiders call the January surge and the March ghost, a flood of new signups in January followed by a collapse in actual usage by March without anyone canceling. Busy is not the same as profitable. A gym packed with people at 6 p.m. might be losing money on every visit because more visits mean more towels, more water, more wear on the equipment. The gyms that make the most money are often the ones that feel the emptiest. Let's look at how this plays out in the real world, starting with a win. Mark Mastro started with a single gym in California in the 1980s and built it into 24-hour fitness, eventually selling a majority stake to private equity firm Forstmann Little in 2005 for roughly $1.6 billion. He took an industry everyone assumed was a local mom-and-pop business and proved it could scale into a national real estate and subscription empire, stacking hundreds of locations under one overselling model.
Now, the failure, and this one is almost operatic, Gold's Gym, the brand practically synonymous with bodybuilding since Arnold Schwarzenegger trained there in the 1970s, filed for bankruptcy in May 2020. The company had roughly 700 locations worldwide, and when the pandemic hit, its entire revenue model, thousands of members paying monthly for a physical space they were now legally barred from entering, evaporated in a single month. Landlords still wanted rent, equipment loans still had payments due. Members, quite reasonably, started demanding refunds for a service they couldn't use. Gold's had to close 30 corporate-owned locations permanently and restructure under Chapter 11, and 24-Hour Fitness, the same chain Mastro built into a $1.6 billion empire, filed for bankruptcy that same year too, closing over 100 clubs. The exact overselling model that made these chains rich in good times became a death sentence the moment members couldn't be quietly ignored anymore. So why does anyone still do this today? The structural shift that saved the industry was the move away from long-term contracts toward no-commitment, low-cost monthly models, pioneered aggressively by Planet Fitness starting in the early 2000s. By dropping the price to $10 a month and removing the intimidation factor, no bodybuilders, no judgment, bright purple and yellow walls instead of black iron, they expanded the total pool of people willing to sign up and never show up, which is the entire engine of the business. This is why the lie from the beginning of this video isn't really a lie anymore for the operators who understand it. The gym isn't selling fitness, it's selling the identity of being the kind of person who works out, and billing you monthly for that identity whether you show up or not. Let's make this concrete with one hypothetical owner running a single mid-sized gym for a year. In the optimistic scenario, they sign 3,000 members at $30 a month, bringing in $1.08 million a year. Personal training and retail at another $150,000. Costs run tight but manageable. Rent, payroll, insurance, and maintenance eat 82% of revenue. Net profit at year-end, roughly $220,000. Now the realistic scenario. Membership churn is higher than expected, so average membership sits closer to 2,400 instead of 3,000.